Okay, we need to see more content like this. Hi, I'm Anton Kulikov with AK Investing, and we're back with another video. My producers put together a list of popular and trending financial advice content on the social media platforms, and I'm going to react to them live. Let's see if we'll get some interesting ones this time. Let's get into it.
I've been investing in other things, but not my Roth. Well, I've put $10,000 in my Roth IRA. Let's see what we got. $25,000. Okay. What do you have? You only put like $6,500 in there when we were kids. Let's see. My Roth IRA is currently worth $178,000. Wow, I made $170,000 completely passively, and it's tax-free.
This is actually a classic case of time and compounding interest being the most powerful force in finance. The S&P 500 has averaged about 10% a year for the last, 50 years or whatever. Very classic advice. I always suggest if you're young, start investing now. Even if you don't know how much you have just a little bit, start investing, because that habit will quickly build into a fortune that you didn't even realize that you could have, especially if you don't invest now.
Say the weird thing.
The majority of people who invest in stocks, crypto, or other types of equities that struggle with consistency, when to take profits, when to cut losses, or when to just hold a position, suffer from these top 3 bad habits that once you kick them, you're going to be making a lot of money. Number 1 is the get-rich-quick mindset and treating the markets like a casino, because just like gambling, you're probably going to lose a ton of money, and even when you do win, you're probably over the long term going to give that money right back to the market. And that get-rich-quick mindset leads into number 2, which is that most investors just want to be spoon-fed everything. What's the hot stock pick? What's the hot crypto? I don't even know what it is that I'm buying, but this person said to buy it. And the third bad habit, which is the core to the other 2, is that most people just don't want to learn a process, because just like going to the gym, it takes time, it takes patience, it takes consistency, and you don't see results right away.
I say this to everybody who starts investing. It's better to start than not start at all. And what I mean by that is a lot of people don't realize it's got so many new, younger people into the markets where they otherwise would not have gotten that exposure. And sometimes it does take a hot stock or some, stupid penny stock or a cryptocurrency that you're never going to make any money in, but those things are also a catalyst for people to get invested in the markets, and we've seen that time and time again. Obviously 2020, 2021 being biggest revivals for trading and investing for younger people. So I think overall, is it not a good way to make money long term? Maybe, but will it probably save young people more money than it costs them because they'll get invested sooner? I think so.
Guys, these are some of my worst investing mistakes and what I learned from it. This is my biggest one. Somebody in Wall Street Bets back in June said to buy this stock, Chiasma, CHMA, because it was about to have a new drug that was going to get approved by the FDA. They posted it at $7, and that's when I bought. So it turned out it got approved, but instead of going up, the stock went down, and it kept going down. And I learned 3 things from this. First thing I learned is about buy the rumor, sell the news. When people hear that the drug is going to come up for FDA approval, the stock goes up anyway. And when they find out it got approved, they get their profit and they sell because they know it's not going to go any higher because it's already pumped up. The second thing I learned is to do research of your own, because it turns out this drug was to treat a thing called acromegalia, which only 1 in every million people have. It was 1 to 3 people. There was no way this company was going to make any money. And the third thing I learned is that I'm a moron.
Okay, we need to see more content like this. Number 1 reason being, so many people get caught up, and I actually did a video on this of how we should actually trade the news as traders and investors, so you can click that in the description below. My producer will link that. The thing that people almost forget, and as a seasoned trader and investor, it's kind of becomes second nature to you after a while, but when you first learn a lesson, the same lesson that this guy's talking about, it is absolutely life-changing, because a lot of people go into the stock market thinking, okay, I have to find the right stock to buy, and I have to know something that somebody doesn't in order to make money, right? And the thing is, realistically, all these news articles that come out about, this stock's going to release this thing, or these earnings announcements are going to be huge for this stock or that stock. A lot of times, even if you gave the person the information before it was released, you will actually find that the amount of times that people will pick the wrong direction of the stock, it's actually like 50-50, right? It's so weird, and I can't really empirically prove this, but I can tell you from my own personal experience, this. If I got a piece of news, Federal Reserve announcements being one of the classics, right? Or some macroeconomic event, like I was told a day in advance, GDP report will be positive, more than expected for this quarter. Obviously, your natural instinct, well, if GDP report's going to be up, of course the stock market should go up. There's so many times where the opposite happened. And the reason is because there's so many other factors at play that even if a certain piece of news comes out that should be bullish or bearish for a certain stock, you could have a complete different direction actually manifest because there's other stuff at play, right? One of the classic examples, a few weeks ago when the GDP report was announced for the third quarter, or the second quarter, the revised number was actually higher than expected, and the market actually sold off. And at first you're like, well, what the heck, how does that make any sense? Then you start digging into it. It's because the chance of a Federal Reserve rate cut went down, meaning that the market expected lower rate cuts. And if that's the case, the market's going to sell off because it values the rate cut more than the increase in GDP. So again, this is obviously retroactive, but in the moment when you have a piece of news come out, you can never take news as a singular variable that can affect something just based on that alone. There are always other factors involved. And this lesson, if people can grasp it, this would make such a big impact in your trading, because instead of looking at the news as something to know in advance or try to make a prediction on, you treat it as something, just another piece of information into a pool of millions and millions of data points that may affect the stock up or down, but it should never be, or let me say it this way, should usually never be the sole reason why you buy or sell a stock.
This is how I would invest $1,000 if I were starting from scratch. First, I'd invest $400 into an S&P 500 ETF like VOO or SPY, and this is typically the largest holding of any portfolio that I start, and it's up 80% in the past 5 years. Next, I would add $200 of QQQ. That's the ETF giving you exposure to tech and software companies. It's done really well in the past 5 years, plus 128%. Then I would put $300 into individual stocks, so I would choose 3 stocks and put $100 into each of them. You want companies that will be around in 40 years, so think of your Apples, your Googles, or your JP Morgans of the world. It's important to not buy any penny stocks. My last $100 is staying in a high yield savings account in cash, waiting for opportunities, and I think this split provides a lot of diversification to stocks via ETFs, as well as you get some concentration into stable long-term companies.
Here's the thing. Recently, the S&P 500 and the NASDAQ have had nearly a one-to-one correlation. I mean, the stocks that affect the S&P 500 are the exact same stocks that affect the NASDAQ 100, meaning that if you're really buying SPY and QQQ, really you're kind of buying the same thing. So in terms of diversification, I don't know if that's really truly diversified, but again, it's like, do you really need diversification if those are the stocks that are going to be leading the economy forward over the next 10, 20, 30 years? That's kind of your decision, right? If you think they're going to continue leading, of course, you don't want to diversify into anything else. You want the stuff that's going to lead us forward. I think picking individual stocks, not necessarily the ones he said, but just any stocks that you kind of like or whatever, gives you some exposure to what risk actually is and helps you understand that the stocks that you pick will hopefully do well. But if they don't, you'll get a better understanding of like, hey, okay, I picked this stock for this reason and it didn't work out. Well, it looks like maybe I need to be a little bit more cognizant of other variables, and just kind of putting like training wheels in the bicycle. Eventually you're going to have to take them off once you kind of learn to, fall, if you will.
Promise, this is not skeezy investment advice. I just want to tell you the story of the worst investment mistake I have ever made. So I had around $60,000 in my Roth IRA, and every once in a while I would check on it and just be a little perplexed why it wasn't growing like my other accounts were. I think after a year it had grown maybe 10, 11 cents. So I started asking around because that just didn't seem right. And I quickly realized that I never invested it. It was just sitting there like a checkings account, because you actually have to make your investment selections with a Roth IRA. So I invested it, and shortly after the stock market crashed, so all my accounts are in the red, including that one, which is really sad. Anyways, a lot of people forget to invest their Roth IRAs. So if you recently set up one, please triple check that it is actually invested in something. Don't be a loser like me.
I don't know how often this happens. Typically when you open up your account app, like you should see a account that has like, most people don't really have that problem. She had a quite unique circumstance. Just, check your account and make sure it has positions in it. That's pretty simple. Make sure to invest your money.
So what's the best piece of financial advice you've ever received throughout your lifetime? Never own more than 5% of your portfolio in any one stock, and never more than 20% in any one sector. So you have to make sure you have a diversified portfolio, never more than 5% in a stock, never more than 20% in a sector. And when the market goes up and down, you won't get...
I will say that when you diversify, it's important to make sure you take into account how much risk you want to have at any given point. The reason is, if you diversify into something and you're considered super diversified, you have like 20 different sectors and all this stuff, but all the sectors are like very low risk and, you know, sometimes even are inversely correlated to the overall stock market, you may actually find yourself in a position where you're not making any money at all, right? So it's important to balance the risk component. Like, you know, you're younger, you want to take a little bit more risk, you know, go a little bit more tech heavy, maybe invest in like 30 or 40% tech of your overall portfolio. If you look at the stock market as a whole, it does go up over time. However, within that pile of stocks, there are stocks that go up more than others over time, and those tend to be the more risky ones. So remember, the younger you are, typically want to take a little bit more risk.
Many wealthy people say they can beat the stock market by investing in leaps options, but no one actually teaches you what they are and what they actually do. I'm a 36-year-old self-made millionaire and former public school teacher, and I can teach you what leaps options are in 60 seconds. 1. Leaps option stands for long-term equities anticipation securities. It's an option contract that allows you to control 100 shares of your favorite stock like Apple or favorite ETF like SPY. And these contracts have an expiration date of more than 1 year. 2. Instead of buying 100 shares of your favorite stock like Apple, which would cost around $18,700, some people will buy a leaps option that controls 100 shares for a lower price. Leaps are leveraged, meaning that if the stock goes up 1%, the leaps option contract can go up 5%. But if the stock goes down 1%, the leaps option can go down 5%. I invest in leaps in a more specific way, but there are risks. Make sure to invest for the long term first and understand the Greeks before investing in leaps.
So options, we haven't really seen one yet. So options are good for getting a fine-tuned risk approach to your portfolio, and that's a lot of the stuff we do specifically at AK Investing. Leaps specifically are a way to get leveraged for cheap, right? And this is the same thing as, you know, similar, I shouldn't say same, but similar to buying on margin, buying futures contracts, stuff like that, right? Where you can control a sizable position, which is a small amount of money. The position goes up, you make a multiple of what you would have. I mean, if it goes down, obviously you can lose a lot more. Typically speaking, leaps are not going to be something that regular investors look at, just because, again, it's like people have to monitor them. You have to see what's going on. Like, do you need to roll your option? Like, there's a lot of stuff that goes into it. You know, if the stock market does nothing but go up, I mean, you're buying leaps, you're going to make far more money than you would if you're just investing in the stock market itself. The problem is, of course, when you have a crash, you could lose like substantially more very, very, very quickly. So again, options are unique in that way, where you have to be very, very careful about the risks involved and understand options trading before you try to do it yourself. Hey, thanks so much for watching. If you like content like this, please give us a like and subscribe so you can see more content when we post it. But thanks so much for watching. I'll see you in the next one. Bye-bye.